The second biggest department store delivered a bumper profit. Earnings at David Jones rose 35% to $110 million. Those numbers were on full-year sales of about $2 billion and spot on the estimates of most analysts. The upmarket retailer has reaffirmed its guidance for full-year profit growth next year of 5 to 10%. DJ shareholders will receive a final dividend of 13 cents a share. Sky Business reporter Desley Coleman spoke with Chief Executive Officer McInnes and started by asking him to point out what's driving David Jones' record results.
I think the main drivers are, firstly, that our brand portfolio is superior to anything else in the market. We've got the best national and international brands, and we take care in those relationships. Secondly, the economy is pretty good, and I think that's true right around the country. And third, we've had the benefits of Texas Pacific Group's ownership of Myer, and all of those three things together have meant that we've done a pretty good job.
David Jones is presented with some unique opportunities with the current restructure of the industry. Can you talk us through those and just how different David Jones is now to Myer?
Yeah, I think at a broad level, our clear difference would appear to be that they're focusing on growing their private label business and growing stores in regional locations and some smaller store formats. Our strategy is an international and national brand strategy focused on high value, high volume stores, and they're fundamentally different. The opportunities that have arisen, many that we've already announced, have been new stores for us, more brands, lower costs, and as we demonstrated, we had a lower cost of marketing. And of course, we're currently in the middle of a renegotiation of our supplier terms.
The industry is forecasting favourable retail conditions for 2008, but we've recently seen equine flu, we've got interest rate rises, and we've also got a drought. Just how are those anomalies going to impact David Jones' numbers in this quarter and for the rest of the year? Yeah,
look, firstly, the horse flu going through them, it's very sad for the industry and obviously for the welfare of the horses. The single biggest market is Melbourne, and it would appear that the Melbourne Racing Carnival is going ahead, so that's a positive for retailers. It's very disappointing that New South Wales can't go ahead. We've got a great relationship with the Randwick Jockey Club and all of the people that are affected by that. It's very disappointing given our relationship, but we hope that whole thing goes through quickly and we have a successful bounce back in those markets. In terms of the drought, it's obviously personally affects a lot of people. We don't really have any stores located in those areas, but it does lead to increased costs in electricity and those types of things. And interest rates on their own are not a determinant of consumer spend and consumer confidence. In the last 15 or 16 months, interest rates have risen nearly 1%, yet our sales growth is 8.9%. But it's when they're impacted by the wealth effect, kind of the share market instability and the credit crunches and housing. And it's a little bit too early to tell that.
Speaking of credit, you're about to launch a general purpose credit card mid-next year. How concerned are you with the price of credit and the vibrations from the credit market impacting the success of that?
Not really, no, because our strategy is a long-term strategy. We're dealing with two global companies in American Express and Citibank, and they have global organisations and global resources, and we've spoken to both those companies, and there's no material impact on either organisation, and obviously they're not exposed so much to the housing market in the US. But we have seen a tightening of credit conditions. We are seeing an increasing in interest rates, and we're factoring all of those things into our long-term forecasts.
You've reaffirmed your 2008 guidance. What is David Jones' growth strategy? Yeah,
we see our growth strategy, firstly in 2008, really coming from our core business. In 2009 to 2012, we think we've got a pretty bright future. We've managed to reacquire our CBD properties. We've managed to increase our dividend from 6 cents a share to 22 cents a share. And as we look over the horizon to the future, we've got 5 or 6 sources of extreme value. The industry restructure benefits will continue in property, in margin, in costs. We'll have the opportunity of a general purpose card, the opportunity of more new stores, of expansion through refurbishments, of gross margin expansion through supplier renegotiations and cost efficiencies. And all of those things should lead to a strong cash position and us being able to use that cash in the interests of all of our shareholders.